If you're building wealth outside of medicine, today's episode could save you from some seriously expensive mistakes. Because while most investors spend time choosing the right assets or strategy, very few actually think about how to protect what they've built. And that's where things can go horribly wrong. That's why we brought in Lisa Hiscock. She's a general insurance broker with global experience in reinsurance and complex risk underwriting. So when she talks about how to safeguard your wealth, it's worth listening to.
The root of it all, it's a promise, isn't it?
Yeah.
It's a promise that when things go badly for you, that someone's going to come there and protect you for the things that they thought you were going to get protected for. Ultimately, it's indemnity, putting you back in the position that you were in had that adverse event not happened.
In this episode, we break down what most investors miss when thinking about general insurance, how policies really get priced, what happens when disaster strikes, and why protecting your portfolio is about more than just ticking a box.
You might invite people onto your property, like a tradesman. You invite a tradie onto your property, they have an injury, chip over your step on the way in, they might sue you and say, you've invited me into
Really?
an unsafe premise. If you've got insurance covering you, it's not your problem either.
So if you're serious about building sustainable wealth, this conversation is your wake-up call. Hi everyone. Welcome back to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have Lisa Hiscock here. Welcome, Lisa.
Hi, thanks for inviting me on.
Yeah. So, Lisa, my understanding is that you're an insurance broker.
That's correct, yeah.
But a general insurance broker and not a personal insurance broker. Is that correct?
Yeah, exactly right. So general insurance broking, mostly in the business insurances, property insurances space.
Awesome. Now, before we start, why don't you give us a bit of background on who you are, how you come to be in this space, and I understand you had a quite an extensive career before this in reinsurance as well, which is another very huge topic, but we'll leave that for now. But so yeah, tell us, how do you get to where you are today?
So previously, I started my career in Lloyd's of London.
Yeah.
And I studied law at university and wanted to go into an industry where I could get my teeth stuck into to commercial clients straight away and sort of very hands-on and learning. So I went into Lloyd's of London and I started underwriting war and terrorism insurance for a British insurer called Hiscock's.
Okay.
Yeah.
Okay.
So that's a war, terrorism, political violence, kidnap and ransom, all these wonderful areas. And we would insure businesses from around 72 countries from that spot. And I stayed there for a while. I went over to the US and worked in Chicago for a while as well. And then I came back and I moved to Australia, started working for AXA.
Yeah.
And at AXA, I was an underwriter in the specialty space, which covers lots of different lines from, property, liability, and again, some of those more specialist lines that I mentioned before. Yeah. And then, back over to Lloyd's of London as a reinsurance underwriter in the casualty space. Casualty means it means lines in professional indemnity, public liability, cyber's also included, and management liability as well. And within that job role as well was a big focus on medical malpractice.
Mm-hmm. Okay, all right. So I guess for those that don't know what Lloyd's is like, do you want to explain what they actually do? Because they're one of the major insurance in the world, actually, aren't they?
Yeah. So exactly. So Lloyd's is actually a couple of hundred insurers that all sit together in the same building. And when a risk is very large or very complex, it will go into Lloyd's, and each of those insurers will take a percentage of the risk each. So they might take 5% or 10% of the risk each. So Lloyd's of London has insured anything from the Titanic back over 100 years ago. Okay. And then it's also insured Tom Jones's chest hair. It insures Mariah Carey's legs and voice. There are a wild array of things that can go into there. They're very complex risks usually that fall outside of the appetite of insurers that are else around the world who, don't want to take 100%
risk on one thing. That concentration risk.
Because it's either too massive or it's too complex. But the more everyday things as well. Reinsurance, for example, is the insurance of insurance companies, and insurance companies get rid of the risks that they don't want to potentially retain themselves. Again, either because the value of that goes too high. So you would get a property insurer who's happy to insure, one or two properties at one time. when there is a large-scale flood and suddenly 2,000 properties are underwater, they're going to want some relief after they've paid out their first $10 million losses or $20 million of loss on those properties.
Yeah.
They're going to want some relief themselves, some insurance themselves. So that's reinsurance.
Wow, interesting. I mean, I'm sure there's going to be a lot of changes in this day and age with climate change and a number of those things.
Absolutely.
But we'll touch on that a little bit later. I guess the first determination we have to make is that we're talking about general insurance and not personal insurance, which is more on income protection, life insurance. That's not what you do.
No, not at all. No, okay. That's a dark art.
That's a dark art.
I don't go near that. Right. I respect those professionals. Right.
So, and obviously, we mentioned all sorts of interesting things you can insure, like Tom Jones's chest hair. Obviously, insurance. What is insurance? It's basically you pay someone in advance for if an outcome or which is usually viewed negative happens, then they will pay you something, isn't it?
Exactly. Yeah. At the root of all, it's a promise, isn't it?
Yeah.
It's a promise that when things go badly for you, that someone's going to come there and protect you for the things that they thought, you were going to get protected for. So it's a promise at the root of it. But ultimately it's indemnity. So indemnity means putting you back in the position that you were in had that adverse event not happened.
And it has to be an adverse event, right? You can't say, oh, I'm getting insured for something good.
Good
is debatable depending on what you say.
I mean, you say that. There is actually insurance out there for a hole-in-one on the golf course. So,
really?
But then that's the golf course that insure against it. Because, if say you see those prize monies where it's like $1 million if you get a hole in one, quite often the golf courses can actually obtain an insurance cover for a hole in one.
For someone winning that.
Winning the hole in one. Prize indemnity. Against the person who's got to pay the prize.
Yeah, well, I guess then, for the person that has the prize, that's a bad thing if someone wins the prize.
Yeah, because then you lose $1 million.
Yeah. Okay, very interesting. So, we talked about what you can insure against, but how does it actually, work? And I'm sure there's some dark art behind it, and how do they calculate how much or the price, a risk? Tell me a bit more how that financial sort of the numbers work behind all of this.
Yeah, so from a pricing perspective, insurers collect a lot of big data. Not only do they collect it themselves, but they also pay for it from other sources, usually. And then many people will have heard of the job role of an actuary. Yeah. Insurers have and reinsurers have large teams of actuaries who will take that big data and they will transform it into something that kind of brings out a price to do with frequency and severity. So, we have very frequent losses. So, you touched on before climate change, the increasing of floods. If you've got a property in Townsville, you'll know that your frequency of flood loss to your property there or flood damage to your properties there is increasing across the properties that are there. And actually, that's got quite a high severity as well. So the premium you're going to pay is going to be really large. If you've got a property that's in Townsville, in a flood-affected zone, that's worth $1 million, the chances are it's either not going to be insured because it's got to a point where it's, going to flood one every 5 years and it's going to cost, $500,000 every single time, or it's going to be, 10% of your property value, something like that. It's going to start getting those figures that are really, really high. We have the opposite side of that, which would be a suburban concrete and brick property that's in, nowhere near any bush zones or anything like that. The chances of that, no fire. The chances of that burning down. Your tenant is a GP practice.
Yeah.
The chances of that having a fire loss is going to be really low. So high severity, but the frequency, the chances of it happening are really low.
Yeah.
Therefore, the premium's going to reflect the chances of it happening. Okay,
and obviously there's some margins in there so that the insurers can make some money out of it.
Yeah, we can pay the actuary wages.
Yeah, exactly. There's that. Yeah. They need to obviously have their cut in terms of that. So in a way, when insurance company, insurance is one of those things where you pay before you ever need that service. And it's one of those things where you pray that you never need that service. So, they get a lot of these money up front. What do they do with that money?
Yeah, that's a great question. So insurers are also investors. With insurance companies, and I'm not an investor for insurance companies, I'm a broker, but we do obviously note what they do, and so with insurance, that money needs to be available to be paid out. So they don't have the access. Only a small proportion of that money could go into like long-term investments. So in terms of being able to put it into a 10-year or 20-year bond, it's not. They can't put large amounts of that money into those kind of investments because they need quick access to it. And for insurers, most years they might be targeting, saying, making a 7% return on equity employed, but they're ultimately going to have years where, the year 2000, we had bushfires, we had COVID, business interruption claims going in. It was just a year where insurers were going to really struggle to make a profit. In fact, some of them are going to make considerable losses depending on, what they insured. And so that money then needs to be paid out. So they need to have plenty of, available cash funds to pay their claims that come in. But that said, so usually their investment portfolio would be, a small slug, 10%, whatever it may be, of longer term investment options. But the majority of it needs to be in short term, easy to access funds so that they can pay claims as and when they come in. And there is a lot of, legal requirements on them to be able to evidence that they have access to that money to pay claims.
APRA that does that, isn't it?
Exactly right.
Because that's, the prudential regulatory agency. And so I guess they're not just a company that takes the risk and makes a product, but they're also a large organization that invests that money directly because that money can't just be sitting there earning nothing. Because then, that obviously decreases their margins and that sort of thing. And
so they'll have a team that look at their investments, and they'll have a team that will calculate how much money can go into what length of investment, what risk of investment as well. So insurers can't lose the money because essentially, even if it's going to be a long term, you look at the different product lines. If you've got property insurance, from an annual policy, you're going to know on the date that policy expires that you're off risk. The property didn't burn down. It didn't flood. You get to keep the premium and that's that if you're an insurer. If it's a public liability policy, or actually let's say a medical indemnity policy, if it's a birth injury and someone's injured during birth, we're not going to know the cost of that claim for a minimum of 20 years because there's no, stopping someone claiming after 20 years saying, actually, this is how that injury developed, and this is now what's stopping me leading a normal life, and this is the long-term care I need. So when we start looking at public liability claims, when we look at indemnity claims, those have what we call a long tail. So insurers need to keep that money. They need to have that money prepared that claim might come in 20 or 30 years' time, or might change shape during that time. Depending that policy will still be valid, and they're still going to owe that money to that insured person.
So what you're saying is that when at a point in time that's triggered, we may not know the full long-term consequences of that.
No.
Yeah, or they can, obviously there will be a time period where they can go back and claim back as well.
Absolutely.
In medical, I think it's 7 years for most things. So after the 7 years, you're like scot-free in a way. But
then there's some very well-known examples, for example, asbestos.
Yes.
And then understanding what that chemical did to people's lungs took a really long time to develop and show. So those asbestos claims were made on policies that were like 20 years old.
Wow.
So the person didn't develop lung conditions for 20 years. And then they started developing, and then they can go back and claim. They'll go and claim from the employer, and then the employer will claim on the indemnity policy they had at the time.
Wow.
Yeah.
Okay.
So those last a really, really long time, and insurers need to be able to hold money for that amount of time, or they need to buy an insurance policy that's called a run-off policy. That means that they can wash their hands of it, but that policy is going to cost them quite a lot of money to get rid of that exposure.
So I guess that's the reinsurance part. You insure the insurer.
Again, they can come and get that.
All right.
But it's why I always find it curious, there's so many emerging risks in the space as well, like vaping, some of the products, the cosmetic products that are coming through.
Or even using, pharmaceutical medications outside of the original intention, or the long-term consequences, like the GLP-1s where we're injecting for weight loss. We don't know what the long-term consequences of those medications are. And, we see that time and time again in medicine that once, thalidomide, we didn't know about the birth defects until many years afterwards. Or one of the anti-inflammatories that was out, I think it was Vioxx, and then it led to increased cardiovascular risks. And we don't know those things until much later. When they happen, it becomes a huge scandal in a way.
And then we go back to that frequency, because it affects, by that point, Zemapet. It affects, there's like thousands of people potentially taking it. The widespread nature of it, even if it's only maybe a small negative effect in the long term, if each person's claiming for
the exposure,
small exposure, it's still going to be a big claim.
That's an interesting thought now, which I haven't thought about. Let's now get into exactly what kind of products that a general insurance broker you deal with, because you mentioned property, right? Even property insurance can be broken down to all sorts of different things, like what are they, for instance? So
a regular property insurance is going to fall into several camps. There's going to be property owners, if we're talking about that, commercial property owners. So that'll be either investors or who are perhaps hands off. They get a professional property manager to organise a lot of their interests in their behalf. But commercial property owners is one thing that might come through in the property owner space. Landlords would be the next one, so residential landlords, I should say. Another form of investment investor that's going to require insurance policies. And then, of course, your principal place of residence, so where you own, insuring your own asset that you live in. Those are the ones that kind of fall into the property space. When it comes to broking, there are specialists within the insurance broking networks. But if you say you're a general broker, usually you would look at all of those ones. You'll look at business insurance for a wide range of businesses usually. It can be anything from, the shopping strips that are being run, or it can be GP practices, anything generalist, or right the way down to niche areas, mining, engineering, those kind of things. And so depending on what risks you have will depend on what insurance broker you perhaps approach. But a general insurance broker will usually be able to help with most of the things you see around you in your community. Okay, so now let's break each different bits. I think for most of our viewers, the kinds of insurance that we'll be getting, outside of personal insurance is your home, for your owner-occupied home. And that's in general you get insurance for the building and you get insurance for the content, I guess. Are those pretty much the only two that buildings, contents, and usually you'd want liability as well, and that's usually included as standard because you might invite people onto your property and, like a tradesman, you invite a tradie onto your property, they have an injury, chip over your step on the way in, they might sue you and say, you've invited me into an unsafe premise. Oh, really? Okay. That's interesting. Is there a lot of that kind of claim in Australia? Or you get them. You get them every now and then? Yeah, you get this included usually. Okay, but it's included in a home and contents insurance. Yeah, usually. Public liability of people. Coming onto your property. Yeah, because I've seen, I think it was Judge Judy in the US. I mean, obviously that's US law where, they held a party at someone's place and someone tripped and fell and hurt themselves. And then they're trying to sue the homeowner. And you've definitely hit it. I mean, hit the nail on the head a bit in terms of the Australian litigation culture isn't quite as aggressive as the US. Not as extreme, but technically that is possible. Yeah, and it still exists. And if you, like I said, the example of a tradesperson that's come onto your property and injured themselves, they might not be able to work now. And they are going to be looking for how they can cover their income and all those kind of things. So there's certainly a risk there to not only that individual that came onto the property, but also to you. Okay. I mean, I think the victim blaming person in me would say, well, you should have had indemnity from your employer and also
perhaps income protection for your own thing, but not everyone has that, and so they want to find someone.
Yeah. Oh, and if you've got insurance covering you, then it's not your problem either. You hand it over to your insurer and your broker maybe, and they take that claim away from you. And
interesting. Okay, so that's from you living and owning your own property, but if you obviously then renting your place out.
Yeah.
There's other kinds of insurance. Yeah.
Just the same. There's one thing to say about homeowners insurance policies. The one thing to kind of consider usually is special features for your property. Have you put solar panels on? Are they covered?
Yeah.
Have you built a swimming pool in your back garden?
Okay.
Is that covered? Is your property a heritage property? Do you have specialist features like stained glass windows?
Yeah.
All those kind of things. From my experience, people don't perhaps think about those things until things go wrong on their property, until they have a property damage loss.
Yeah.
And then they maybe have a policy that they've had for 10, 15 years that's just rolled over.
And
they've not checked, they've not
updated
it, and they've done all these renovations and all those kind of things.
Okay.
So those are the things to be aware of. If you are doing renovations as well, making sure that the developer or the contractor
the builder,
that you've got, the builder that's coming onto your property, is either covering the works that they're doing or that you've organised insurance for that, because it's not typical that a homeowner's insurance policy would cover significant construction works on your property. Usually they kind of draw the line. Usually you see insurers will quote
like minor repairs.
If it's over $40,000 or, if it's more than minor repairs or it's going to take more than a certain time period, usually they ask those kind of questions.
Okay. So what are the risks? Say a builder comes in, they try to change a wall or something, and then the whole building collapses. Is that what we're talking about?
They should have the policy for that.
Yeah. Okay. Sure.
There should be under the contractor's liability. Yeah. Absolutely. But if you're bringing someone on, I would ask the question. I'd definitely ask. Are you insured? And
are you insured? And what are you insured for?
Yeah. And does the limit cover the value of my property?
I see. Yeah, because the worst case scenario could be the whole place is destroyed. Yeah. So I mean that should be routinely covered in people who deal with residential properties, is it not? Or, I mean, as part of them providing a service, my understanding is that if you build residential properties, you have to have some sort of insurance cover for defects up to a certain time point, and that's why a lot of these companies, they just wind up because they don't want to deal with that risk.
That's exactly, you definitely see that. And for contractors, that particularly that defect insurance cover has got more expensive over time. It's got more expensive because there's been more claims and there's been a history of there being issues. And the same for a number of roles within the property industry, job roles within the property industry. We've seen a lot of claims. Valuers would actually be one. They've had a lot of claims for getting valuations wrong. And I've kind of addressed that in the opposite way around. But that was another thing to take into account. Any property insurance that you're seeking, key point of contention is the value of the property. Yeah. Did you insure it for a high enough value?
Yeah, or replacement cost of the whole thing. Yeah. And I guess that has to be also indexed to what it costs today, or is that? Yeah,
absolutely. So, and it would be one of the areas of contention we see most frequently in property insurance losses. So the property burns down and it was insured for $1 million and it's found that the replacement value is actually $2 million. And it's, it happens for a number of reasons. The first one it happens is because somebody bought that property 10 years ago and they just didn't index it. As you said, inflation costs, they haven't kept up with what it was actually going to cost today when the losses happened, the fires happened. The other thing that happens is that they make an estimate, but they don't include all the additional costs of what happens when there is actually a total loss on the property or a loss to the property. So it's not just rebuilding it. What are those materials going to cost? You've got to think about the removal of debris. If you've had a total fire loss on your site, actually how are we going to get rid of all that debris? How are we going to get rid of everything? Is the ground now in a condition it can be built on? Once it is in that condition, and that process of removal of debris can cost up to 20% of the replacement value, sometimes 30%. Depending on when it is. So, what's that going to cost? other fees, other professional fees, architects and engineers, coming and redesigning the property, any improvements that might need to be made.
So it's not just like a current valuation of how mumuch this property is worth if I were to buy it.
No.
Yeah.
And we can go down such a big rabbit hole here as well, because if you're in an area where, you're getting bushfires, you see bushfires at 2020 in the Blue Mountains, there were a lot of properties affected all at the same time. The contractors in the area are then really busy. And so you've got a demand surge.
Jack up their price.
Yeah, it's true. It's going to be 20% more to get that sorted out just now. And the make safes, going around and that tree's fallen down on your neighbour's property or hanging over the top of it. The make safe to go and remove that tree is going to be more costly at a time when the demand's higher.
Yeah, because I own a commercial, and I think the insurance that I have on it is about there's about a 20-25% margin on from the overall value on how much I spent on the thing. Yeah. Okay, very interesting. So any other pitfalls when we talk about homes? And I guess the next part is that if you're a landlord, there's additional insurance for your tenants destroying things or not paying rent. Is that something that's still quite common these days? Because I think there was a bit of
so those covers are not included as standard, but are very commonly provided. So you touched it, tenant default of rent, theft by tenant, and accidental damage. Those covers are certainly available in many circumstances, but you have to check to make sure that you've opted in for them or your particular insurance provider has provided those. And again, tenant default of rent, it's one where there is a frequency element to it. So it's quite common to be claimed upon, but not usually a big severity. So most of the time, if you've got a poor tenant, in the majority of scenarios, hopefully you'd get them out within 6 months, or you'll rectify the situation with them within 6 months or so. And so you're confined to that loss of rent. So, from an insurance perspective, some people opt not to buy it. They look at that total cost and they think, oh, that's actually something I would, take a risk on myself.
Take a risk,
or they're managing the property themselves and they feel like they know their tenant really well. It's their mother-in-law. They're probably not going to buy that cover.
Or they're more likely to default depending on how you look at it.
But for a lot of people, it's a good cover to get.
And I think one of the other things that we haven't addressed, between apartments and a freestanding home, the freestanding home, you're responsible for the building, whereas in an apartment, the strata is responsible for if the building burns down, right?
Yes.
Yeah. So that's also, where some of your strata fees is going, I guess.
Yeah, exactly right. The strata is responsible, but you will feel the impact if the strata gets it wrong. So again, you're talking to the person that would always double check it. What I look for if you own a unit on a body corporate or on a strata program, whether it be commercial or residential, it's usual practice for the strata to arrange the building insurance. Building insurance is typically, in most cases, the walls, the roof, everything outside of the property to rebuild it. Yep. Things that you need to consider and investigate as to whether they're covered are the contents inside. Usually that will be on you. So anything that you've put into the property yourself, and that can include, carpet tiles, blinds, any kind of white goods if you've put in fridges and ovens and stuff like that. It will also, you need to think again about public liability. The strata's public liability will be different to the public liability that you will need to hold. So as a landlord, your responsibilities are different to that of the stratas. You might have your tenant might say, report something internally in the building, in their unit, that they haven't made the strata aware of, because you're the landlord and you're the one that's going to sort out anything internal problems. Yes. Yeah. Therefore, if that doesn't get organised and there's a contentious claim about
they injured
themselves or their properties damaged as a result, they will bring that claim against you. Yeah. Further to that, there are claims where everyone gets listed. So Grenfell Tower, when we saw a lot of the cladding issues, so Grenfell Tower in the UK a number of years ago, really severe, horrific fire. Yeah. A lot of people lost their lives. Obviously significant, property damage to anyone who had any units in there. That was a scenario where afterwards any property owner was listed. The body corporate, obviously the Strata, was listed itself. And in a public liability claim like that, again, you want to cover yourself.
Yeah. And I guess public liability, where is that shared risk? Is that across all public liability sort of policyholders, or is that specific to an area, a country, or state? How do they? Because insurance is basically a sharing of risk, isn't it? So how is that risk shared between, say, landlords or between public liability and all of those? How is that aggregated?
Aggregated. Do you mean from the insurers providing the cover, or do you mean from the individuals purchasing it?
No, I mean from the insurance company, because because the insurance company, they would have, say, 10,000 homes and content insurance. Yeah. So I guess the question is, where is that? At what level is the risk shared across all of the policyholders? If you buy home and contents, and say a particular company has 100,000 policies, when one person claim, does their individual policy go up, or does everyone's policy goes up by a tiny fraction? Where is that shared?
So it's very dependent, and it's a great question. So when we look at a scenario, say like flooding, insurers have become, they've developed a lot of maps, like realistic disaster scenarios, and like technical maps for how a flood might happen. So they can draw a ring around Townsville, and they can see, what properties they insure, what the values of those properties are. If a flood was to go through the exact areas that it would be most likely to impact, and they can draw a scenario, a realistic disaster scenario, being their like total maximum loss, their maximum foreseeable loss from that incident.
Okay.
You touched on it brilliantly when you said public liability, because it becomes much more difficult to aggregate for a lot of public liability losses. If you've got something that's going to affect thousands of people in different geographical areas, it becomes really difficult. The one that's become really tricky and that's taken a lot of thought has been cyber, because cyber doesn't respect legal borders either.
It doesn't throw boundaries at all.
So that then becomes very difficult to aggregate. So the way that they then aggregate for their losses, or account for the largest maximum loss they can have, is they have to do it by either restricting the amount of cover that they can give full stop, and that causes prices to rise, or they can do it by buying reinsurance, and then reinsurers also buy reinsurance. It's called a retrocessionaire, but we're really getting into...
Well, someone has to hold, be the ultimate person that holds all the bags, right? I mean, someone has to ultimately holds the end risk. And in a way, I guess the question is that how far can a company individualize the risk, and at what sort of resolution can they do that? Can they say, okay, using a Townsville example, this whole street they're gonna be grouped at the same amount of risk, whereas this house has is on stilts, so we're going to reduce their risk, and everyone else around whose, their slab is not high enough or whatever is going to have a higher risk. Can they do it at such a granular level, or are we just saying, that whole street is in a 1 in 100 year flood zone, so we're going to increase the risk because it's across the whole street? So
they do it across all of it. So that one with the stilts might pay a $5,000 premium. The one without the stilts might pay a $7,000 premium.
Okay.
And the one with, 3 tenants living in the basement isn't going to get insurance.
Okay. So I guess so the answer to that is that for those kind of insurance, you can really individualize it. There's mitigating factors, and then there's added risk factors, and it's really the broker or whoever you're buying the insurance from to have that conversation and to
understand what mitigating factors you put onto your property. Absolutely. So, and I have this with a lot of my clients, landlord clients that are up in Queensland. We talk a lot about what cyclone proofing they've done for their house, what flood mitigation measures they've got, whether they've got pumps, whether they're still using a basement as a living area, all these kind of things where it's going to affect their chances of getting insurance. And if they are going to get insurance, how much it's going to cost.
Yeah.
But ultimately, there has been a response to the fact that a number of insurers have either retreated from providing property insurance in high risk areas, or they're charging so much money now that it's not economically viable. The Australian Reinsurance Pool Corporation, which is an Australian government organisation, are now providing a flood backstop to insurance policies for residents in some of those affected areas.
I mean, if you look at the Northern Rivers, Lismore, that whole apparently that whole town is not really insurable anymore. Just because it's flooded so many times. Yeah,
and it's an economic problem. It's become an economic problem because you may have average income in the area, average salaries in the area might be $70,000 or $80,000. Average cost of a house might be $500,000, and then the insurance premiums are going to be $16,000, $30,000. To get flood cover. Of course, people aren't going to buy it when it's becoming such a large proportion of their income. It's not feasible.
It's just not attainable anymore.
So then it becomes like, do they move out? Do they not insure? If they don't insure, and there's thousands of properties that get affected at the same time, that then becomes a government problem because they're going to need to go and rebuild the town and find money in an emergency setting. Yeah. So there is definitely action. And, we're seeing that emerge in Australia. In the US.
And that gets political.
In the US, we've seen it in Florida. So many parts of Florida that are uninsurable. Yeah. And then we've got government insurance and reinsurance pools that are emerging that are having to provide government-funded insurance policies, essentially.
But at some stage, the government money is also not good enough or runs out as well. So where do you do then? What do you do?
And it's selective. How do you select the areas? Do you draw a line? Insurance is unaffordable in other areas as well. Bushfire-affected regions. If you look at trying to buy an insurance policy at the moment for properties in the Kosciuszko region for bushfire cover, that's challenging. That's really difficult. And then is it just residential properties or are you going to extend that government funding to commercial? Yeah. And okay, you can say, it's commercial property. It's not, homes. It's not as important, but that's people's livelihoods. That's
people's jobs and how they, fund their livelihoods, right?
So, and how they're providing services to a community too. So it's complicated.
I mean, it's interesting because I take that analogy back to health insurance. In Australia, health insurance is one of those weird things where the risk is aggregated at a population level and not to an individual level. When you take out private health insurance, for instance, I think they can't discriminate against you if you are the most unhealthy person. You can still get cover, and whereas in other countries that may not be the case. Right, they can discriminate against health if you're trying to get life insurance, but you can't do it if you're trying to get private health cover in Australia. Yeah. So I guess that's something the government has to come in, regulate, and say if you're going to do this, it has to be assessed at the entire population level. I mean, I think they do adjust for age, but that's about it, isn't it?
Yeah. I'm not an expert in private health insurance in terms of that's not something that people that
you deal with,
I break with. But I've obviously bought my own, and
because they don't even ask those questions.
No, and coming from the UK as well, I moved over in 2014, and I had no idea. In the UK we just have the National Health Service, and that's kind of it.
Exactly.
And it's not a particularly big industry, the private healthcare, and if it is, it's very niche. Yes. Whereas here, obviously, it's much more regularly purchased.
I guess to almost summarize, it's like the insurance can be. Obviously, government plays a huge role in that in terms of how they regulate the sectors, saying what you can discriminate against. I mean, maybe discrimination is not the right word, but like what characteristics or properties you can adjust your risks or your pricing based on. Yeah. It's basically price discrimination based on a certain property of whatever you're insuring. As in property, I mean, not in terms of homes, but like location, the characteristics, right? So, and the more niche you get, the more sort of levers and you can get to play with that. I mean,
the more options you may have, or you can actually definitely put an argument or a case to an insurer that you're a special risk, so you're in a flood, like a higher flood exposed area, for example. But you've definitely got.
But you got a 5 meter stilts or something.
Yeah. But it's, in terms of the government assistance and government influence, I predict we'll see more of it, with climate change.
Yeah.
With the more, the higher frequency that we're having of severe weather events, we're going to see, there is going to have to be some changes or some impact. Yeah.
I mean, speaking of severe weather events, I used to remember when I built my my practice, we had this 1 in 100 year sort of flood zone, or the 1 in 1,000 year flood zone. That's not what it means, right? It's not like it's not an event that only happens once every 100 years. It's really there's a 1% probability per year of it happening.
Yeah.
And so that risk accumulates. And I think the way people look at risk is also very very skewed in the language we use. But then also going back to the, you have these charts. Those are all historical charts. And we're basing it on things which may not be true today because either climate has changed or, people have changed.
Yeah, that 1 in 100 year is now a 1 in 50 year. Yeah. It's gone from a 1% to a 2% risk. It depends on where you are, but there's certainly, we've got technology on our side a lot more now. So the mapping that's used for severe weather events has become a lot more astute. It's based on a lot more data. We can take the data that we see in one country and we can try and make predictions on what we might see in another. So we know that a certain severity level of cyclone hitting the coastline in Florida, we can then use that to forecast what that severity of cyclone is going to do if it hits Brisbane or something similar. So we now have the capability to model model those kind of scenarios.
And is that quite recent? Is that
I wouldn't say
it's in the last 10 years or something like that? Or?
Probably a bit longer than like 10 to 20 years, definitely longer than that. They've definitely been around for at least the length of my career, which is 16 years. But the difference is the sophistication of it.
Okay.
And the capability and the fact that now it's learning because we now have
AI
modeling on our side as well. So it's now got the capability to learn, and data sharing's, increased exponentially during that time period.
Okay.
Now it's not just, you look at some of the bigger companies that do the modeling. RMS is probably one of the biggest ones in the world. They now pull data from so many different sources, and they have been doing so for so many years, whereas 20 years ago we weren't as good as sharing data. We didn't have the capability to do it so much. So it's really
and I think I heard something about the planes when they fly, they actually are weather instruments, and they actually sell that data to organizations like that to predict the weather. And one of the things that we all noticed, I think, during COVID was that because there were so few planes flying, the weather prediction was really terrible. And I guess all of these technologies will obviously go into not just insurance and disaster sort of forecasting, but also things like agriculture and all those sort of areas, which is quite interesting. I just thought, a bit off point, but
no, it's definitely that. And in the insurance industry is a great tool for gathering data and information. It really is. There's very few places that or not very few places, but you do give a lot of data to your insurers, and then they're monitoring your fortunes constantly. So they do stand to be really good providers of data.
So Lisa, before we wrap up, what sort of services do you actually sort of provide for some of our listeners?
Insurance brokers will take on board your information about your risk. So they might do that as a portfolio. As you mentioned, a lot of the listeners that you're going to have today will have multiple different interests, from businesses to property investments, to their own assets. So they will look at all of the risks that you have, all of the insurance policies that you have, and they can take on board that information and get quotations for you, compare quotations from numerous different insurers, make sure that you're getting the cover that you expect, talk about risk, covers that you haven't perhaps purchased and things that you're, risks that you're taking on yourself, and then look to obtain the best terms for the best pricing for you. There's no obligation to use a broker in terms of if you come and you ask just to have an assessment on your particular scenario, you don't have to go ahead with the quotations that a broker provides. You can then choose to carry on as you were, or you might choose to go with that broker, and that's at the point where, as the broker, you get paid is when you purchase the policy. So up until that point, you can get, an obligation-free conversation about your risk and then insurance quotation options. And furthermore to that, you can talk about your business, what risks you've got insured at the moment, emerging issues. I think we'll talk probably a bit about cyber at some point as well. But, those kind of issues that perhaps you haven't thought of yet, or you haven't realised there's an insurance policy available for that yet. Those are the kind of things that your broker will be able to raise with you. And then after you've bought your insurance policy, if you are unfortunate enough to experience a loss event, your broker will submit the claim on your behalf and represent you during the claims process. So they'll do all that annoying follow-up that people usually find quite frustrating and taxing at a time that they've had something really tricky happen.
I think one of the main things is like car insurance. Like people would love to just palm that off onto someone because that's a painful process. I think most people have come across.
I think and with car insurance, it's one with some brokers will look at car insurance,
but it's not a typical,
not commonly insurance broker policy, but can be. It just depends on again. Usually, there's perhaps a cost involved when it's car insurance. Because the premiums are
so low. Yeah, exactly.
Yeah.
Okay. No, awesome. Thank you for joining us and giving us a educational talk on insurance. It's been very enlightening.
No, thank you for having me. It's been a pleasure. It's been awesome. Thank you.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.